But we want to start with these incredible numbers we saw showing just how much money is fleeing from the financial space and where some of it appears to be going. It's a major market story. And joining me for the hour, members of our investment committee today, Shannon Saccocia, Sarat Sethi, Steve Weiss, Josh Brown. As you know, stocks are in the midst of a 4-day losing streak. Down 5 in a row would be the longest since February. Trying to avoid that. Have some work to do this hour. Dow's below 35,000. It's a loss of 86 points. There's the S&P, which is a fractional loser today, as is the Nasdaq and the Russell 2000. The 10-year note yield sits just below 135. It's at 1348. Let's get into, though, this interesting data that we saw from Bank of America, because it tells Steve Weiss quite a story that you're right in the center of. You've got the largest redemptions from the financials in 11 weeks, the second largest since the pandemic began, and the 11th week of inflows into tech. So you got a couple of different stories to chew on there. But the financial side of it I find very interesting. And you are in J.P. Morgan. You're in Bank of America. You're in Goldman Sachs. You're in the XLF. So it hits you squarely where you're putting some of your money. What do you make of the fact that there's all of this money coming out of a space where you keep putting money into?
You know, Scott, it is a great point to bring up. And frankly, what I make of it is, I don't know. Add it to the confusing data, confusing information that we're getting. Add it to the JOLTS number, which was inexplicable in my view. So I think it's a reversal of momentum trade that went into the bank stocks, into the financials, because this is not the time to be selling them. This is actually a time to find any weakness to add to them. Now, they've had great runs. They've not been underperformers. So with which I believe you will see, a steepening yield curve, I also believe that the Fed's going to pull forward their rate increase schedule. I think you want to buy them. I don't want to sell them, and I'm not selling them.
But I mean,
I'm very full, as you point out, so I'm not adding.
No, I hear you, but I look at their performance, Steve, over the last 3 months. The KRE is down 6.5%. Bank of America, which I know you love, is down 3.5%. Citi's down 9.5%. J.P. Morgan, which has ownership on the desk today, is down 2%. Sarat, you as well. Your Citi, your JPM, your Morgan Stanley. You claim this is the place to be. The market seems to be voting otherwise.
The market today is saying, they've been voting the other way. But I agree with Steve. I mean, it's rare when I do. But I do think, look, these stocks have really good catalysts coming forward. Their valuations are still cheap, great balance sheets. I like the ones that I own with the management teams. And I do think Steve's right. Look, the Fed, we're probably going to get, the taper slowing down. Those catalysts will come and help the stocks. But there are other things that are helping these stocks, too. They have great asset management businesses. They have great M&A businesses and great franchises. And I think at this point, what you're seeing is some defensiveness of investors to say, hey, we have some uncertainty about reopening. This, Delta variants are there. Why don't we go to the safe place? Which, as you mentioned, this is the second worst loss for financials. The same thing happened over a year ago. So I like the position we're in. I think there's good opportunity there, but it might not work for a few weeks. But I think longer term, we're in a much better place being in financials than some of the other stocks that are trading at really high valuation.
I mean, Shan, it's been a winner to be in these names, obviously, on the year. Everything is up, and in some cases, substantially. Goldman's up more than 50% on the year, as is Morgan Stanley. And you've got some exposure here, too. Not so much in the large money centers, although you're in J.P. Morgan, but you do have financials exposure. And it's important to point out that when you invest in financials, we often get bogged down in the big money center banks and the largest financial institutions. But you can also talk about some of the other names in the space that have provided some big dividends to investors.
Well, I think the reason that we get so caught up in banks is that, we're getting so caught up in the interest rate conversation and as it relates to the yield curve. So I don't think it's unwarranted. And I think that, you may be seeing some folks taking some of those gains off the table because perhaps there is uncertainty about the pace of tightening, true tightening, not just bond tapering, but tightening in the form of higher interest rates. We, over the last several years, Scott, it's been hard to bank on the central bank getting tighter. I mean, we've seen the fits and starts here, and we're coming from such a low level. So I think there could be a little bit of profit taking here, perhaps some defensiveness, as it relates to the Delta variant. But I think it's an important note that if you're looking for a rotation to value, to stocks that are trading at a more reasonable valuation. To your point, there are other places within the financial sector to look at. You can look at True Asset Management. You can look at a firm like Schwab, and who is obviously benefiting from the growth of retail trading and can also benefit from a steeper yield curve. You can look at the exchanges. There's a number of ways to play financials. Insurance is a particularly defensive way to play financials, but could insulate or create a barbell within your financials exposure. So I don't think we need to be running away from financials, but I think there could be a longer tail here to this trade actually bearing out, and we're seeing some profit taking over the last several weeks.